In this video, I want to talk about a popular options strategy called LEAPS, short for Long-Term Equity Anticipation Securities. I will talk about what it is, how does it work, why you should trade it, and also why you should not trade it. Also, throughout the video, I'll be using the Momo Singapore app to explain the LEAPS strategy, which, by the way, if you have not signed up to them already, you can sign up with my link down below. Deposit $2,700 to get up to 1 free Apple stock, $20 cashback, and commission-free options trading for 30 days. Alright, let's jump right in. Okay, as the name suggests, LEAPS are options that have a very long expiry date, typically 1 year or more. But why LEAPS? So remember that one call option contract equals 100 stocks. So when you buy LEAPS, you are basically owning 100 stocks but with a lot less capital. Or in other words, LEAPS give you the leverage to buy 100 stocks. Yes, the same kind of leverage as margin, but without having to worry about all the margin costs. And yes, I can already hear people typing down in the comments, options can expire worthless, LEAPS are stupid. Yes and no. If done correctly, LEAPS is a very powerful strategy to grow your portfolio, and the risk is very minimal. Let me explain. Let's look at an Apple call option that expires 2 years later in 2025. Right now, Apple is at $125. We will go deep in the money and check out this $50 strike call option. This option costs $79.52 to buy, or $7,952 when you multiply that by 100 stocks. So by buying this option, you're essentially paying almost $8,000 to control 100 Apple shares. Compare that to buying 100 stocks outright. You will have to pay $12,500. That means by buying LEAPS instead of 100 stocks, you just save $4,500 in buying power. Then you can go and YOLO, invest that money that you have saved into some good stocks to earn even more money. But what's the catch? There's always a catch. Yes, you're right, there's a catch. But before I talk about that, let me do a quick refresher to understand how option premiums work. Recall that this option is at the $50 strike price. If you were to exercise this option, you would be buying 100 stocks at $50. Then if you sell all of them away immediately, you would instantly profit $75 per stock because the current stock price is $125. 125 minus 50 is 75. This 75 is what we call intrinsic value, the value that we will get when we exercise the option. The premium of this option is $79.52. So out of that premium, $75 is the intrinsic value. But what about the remaining $4.50? That is the extrinsic value. Extrinsic value is the part that moves up and down depending on how much time there's left and how volatile people think the stock will be. And the catch of using LEAPS is the extrinsic value, because this value will decay every day, even during weekends and holidays. So if you own a LEAPS and you say Happy New Year, you suddenly lost a bit more money that day. For this LEAPS, the data is negative 0.0091, meaning this LEAPS is losing 91 cents every day. And by expiration day, how much you would have lost when the extrinsic value decays completely? Just $4.50 multiplied by 100, or $450. That's the risk between buying 100 stocks and buying a LEAPS. So it's not like what everyone says, all options will expire worthless. Oh no, out of the money options will expire worthless because they don't have any intrinsic value. The only value that they have is extrinsic value. And extrinsic value will decay to $0 when there's no more time left. On the other hand, in the money option still has intrinsic value after all the extrinsic value has decayed. And because in the money option still has intrinsic value, you can choose to sell it for profit or exercise it to convert it into 100 shares. But of course, if you are dumb and decide to do nothing with the in the money option, they still can expire worthless. Though in most cases, the broker will just automatically exercise in the money option for you. Now, to see how good LEAPS is, let's check how would LEAPS perform in different scenarios. Scenario 1. Apple comes out with an Apple car and the stock shoots up $250. What is our profit? Remember that Apple is $125 now. If Apple goes up to $250 with 100 stocks, we will profit $12,500 or 100% profit. But what about using LEAPS? With the $50 strike option, our profit is 250 minus 50 strike minus the 79.52 premium, or a profit of 120.48 cents times 100 or 152% profit. As you can see, by using LEAPS instead of 100 stocks, our profit would be almost similar, and in terms of percentage, it would be much higher. Scenario 2. Let's say the recession continues on and Apple falls to $50 or at the money of our option. What is our loss? With 100 stocks, we would have a loss of $7,500. What about LEAPS? Our intrinsic value would be $0 because $50 stock price minus $50 strike equals 0. And our extrinsic would also be $0 at expiration. That means our LEAPS just boom and we lost everything. In our case, our loss is the LEAPS premium, which is $7,952, which is actually very close to the loss of owning 100 stocks. The only difference is that you lost an extra $452, which is the extrinsic value. Scenario 3. Let's say a meteorite destroys all of Apple's servers and offices, and the stock crashes to $0. For stocks, we will lose 12.5k. But for LEAPS, we will only lose the premium that we paid, which is just $7,952. So now, you are starting to see how powerful LEAPS is. With LEAPS, you get to control the same 100 stocks, but using a lot less capital. When the stock goes up, you will gain similar returns as owning 100 stocks. When the stock goes below the strike price, your loss is actually capped at the premium, and it won't go lower than that. So in short, by using LEAPS, you are risking less capital while having the same profile as 100 stocks. Yes, you are paying extra money for the extrinsic value, or in this case, $450 fee to own the LEAPS. But in return, you save $4,005 in buying power. 450 divided by 4,005, that's 10% over 2 years. Do you think that you'll be able to earn back that 10% in 2 years by using the buying power that you have saved up, or at least reduce your losses? That shouldn't be too hard, right? At the very least, you can invest in some 4% fixed deposit over 2 years and you will easily make back 8% already. LEAPS sounds good leh. Let's convert all my stocks into LEAPS ah! Hold up! Before you do that, here are some downsides of using LEAPS. As mentioned earlier, the difference between 100 stocks and LEAPS is the extrinsic value. This is the fee that you have to pay when using LEAPS. If you convert your stocks into LEAPS, you have to keep paying this extrinsic value every time you roll into a new LEAPS every 1 or 2 years. And over time, this premium will add up. Though, if you are smart about it, you can roll early, like 1 year before the option expires and before the rate of decay accelerates. But a bigger problem with extrinsic value is that it depends on the volatility of the underlying stock. The more volatile the stock is, the higher premium that you will have to pay. For the Apple option that I showed you just now, the extrinsic is about 5.6% of the premium, which is actually quite high. That's because Apple is moving quite a lot lately, and that has caused the implied volatility to go up. So if you wanted to buy LEAPS during this period, your fee would be much higher. Second, because of how deep in the money the option is, the bid-ask spread tends to be very wide. In the example just now, the spread is about $3.90 wide. When you keep buying and selling LEAPS, the additional cost could add up over time. Though, you can overcome this by trying to buy at the mid price, which will reduce the spread by a little. Or you can also exercise the option, sell it, then buy the LEAPS again, which will reduce the premium. Or you can just exercise the option, sell the stock, then buy the LEAPS again. Third, by owning LEAPS instead of 100 stocks, you won't be receiving any dividends. But I would say this is just a minor downside for being able to save a ton of buying power. Fourth downside, Don't forget that LEAPS still represents 100 stocks, and the problem with that, if the stock goes down 60-70% Tesla, you will see your entire LEAPS drop by 70% and shit your pants, especially if your entire portfolio consists of only LEAPS, and especially if it is going to expire soon. So if you want to own LEAPS, here are some rules that you will have to follow. First, LEAPS can be a part of your long-term investment strategy. Not 100%, a part. The reason is because while LEAPS are good and all, you want to avoid a situation where the stock tanks 60-70% and you end up panic selling your LEAPS. So if you want to invest in LEAPS, I would say you should have at most 5-10% of your portfolio in LEAPS. The rest, keep it as stocks, because the most important thing with investing, besides making money of course, is to be able to sleep well at night, yeah? Also, so far, I've only shown you deep in the money LEAPS. The reason deep in the money LEAPS are good is because they have very little extrinsic value to decay. But the problem with deep in the money LEAPS is that they are quite expensive to buy. So one way around that is by choosing less deep in the money or even out of the money LEAPS where the premium will be a lot lower. For example, if you bought LEAPS at $150 instead, the premium would only be $1,910, which is a lot cheaper. And that is exactly what this blogger did. 50% of his portfolio was out of the money LEAPS. And guess what happened when the market tanked? He lost a ton of money. This is why out of the money LEAPS is so dangerous. For deep in the money options, the stock has to only go up by a bit for you to break even. But for out of the money options, because of how much money it is losing every day, the stock has to go up a lot higher for you to break even. And if it doesn't go up, oh, you will lose all your money. So yes, even though out of the money LEAPS are cheaper, they are also a lot riskier. If you can't afford deep in the money LEAPS, you are just a poor boy. Just kidding. If you can't afford LEAPS, it just means that LEAPS aren't for you. Go improve your career first or earn more money first. Only when you can afford LEAPS, then come back and look at it again. Finally, LEAPS is not a get-rich-quick scheme, yeah. There's an option guru that says that by using LEAPS, you can grow your 5K into $2 million. And in the video, she back-tested this to show you that it works. Amazing! But the problem with that is, she was using the years in the best bull market ever to back-test this. If she tried this on a bear market or in a lost decade, her strategy wouldn't work. And to make it even worse, you will keep paying the extrinsic value premium every time you roll, making your losses bigger and bigger. In short, don't treat LEAPS as a get-rich-quick scheme. It will make you rich overnight, yeah. So that was a quick introduction to LEAPS. But do comment down below and let me know, what are your thoughts on LEAPS? Is it a good or bad idea? Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.